Uh, Dear students, Assalamu alaikum. This is Mustafa Mirchawala, your trainer, F6 TX trainer. And today we are going to discuss some revision things of F6, right? Okay. And the objective of this session is motivation. Objective of this session is motivation. And I'm sure that you guys have completed the course by now, okay? Because at the beginning, I always instruct my students to complete course on time. That's the major thing, okay? Like if your paper is on 6th or 7th, so you need to complete course by 15th or 14th of November, like this, right? Okay, so you have at least 20 days for revision, 20 days for revision, 20 days for articles reading, 20 days for reading examiner report, for solving mock exam, right? Okay, so these things are very important. And one more thing, in the beginning, I always, in my routine classes, I always instruct to make exam folder. I'm sure majority of you are aware of what exam folder is, okay? You need to make summary, you need to make summary of each and every, you need to make summary of each and every, you need to make summary of each and every topic. After studying each and every topic, write the whole topic in one page, write the whole chapter in one page, okay? So for example, if there are 20 chapters, you have 20 or 25 pages summary, so that you can revise those things anytime. And for F6 paper, TX paper, this is very important, because we all know there are many small things to learn in F6, okay, right? So in front of your screen, I've just shared you my some of my results, some of my star students results of September 2021 attempt. This is just for your motivation, okay? When these guys can do it, why can't you? When they can do it, when they can score in 70s, 80s, 60s, can't you score 50? So I always say that 50 is everything. Your first target is you have to cross the line, you have to cross the border, right? So scoring 50 is not a big deal if you plan it, right? Like there are some very easy marks in your exam, like capital allowance is very cash marks, right? Similarly, the three areas, CGT, IHT, VAT, they are separate areas, you can pack it out. Then then you have corporation tax. Corporation tax is sort of very 20 separate marks, 20 separate marks, 15 marks in the last section C, and some MCQs as well, okay? So I would say you can easily score 50 plus marks. 50 plus marks is not a big deal. What happens is you guys just get confused in the examination, and what you do, that one difficult question, you spread the tension of one difficult question over the rest of 90 marks. That's the issue, okay? So let's start. We are going to start it with income tax computation, some discussion of income tax computation. And in today's class, I'll be discussing some latest questions from examiner report. I'll be discussing some latest question from examiner report, okay? One more thing, I have in your chat box, our administration has sent a WhatsApp group link. All of you are requested to join that WhatsApp group, okay? So that we can send you further things after the class in that WhatsApp group, okay? Must join, all of you must join the WhatsApp group, right? So first of all, my dear student, the thing which is written in front of you is fiscal year. You are going in this exam, in this upcoming exam, your fiscal year will be 2021. Your fiscal year will be 2021, okay? Fiscal year is the time period for which individual pays tax. Individual pays tax for fiscal year. Individual pays tax for fiscal year, right? So this is your fiscal year in front of you, 6th April 2020 to 5th April 2021. 5th April 2021, right? Now, first of all, whenever you are asked to calculate tax for individuals, three columns will come in your mind. three columns will come in your mind. Three columns will come in your mind. First is non-saving, second is interest, third is dividend. Non-saving, interest, dividend. Okay. For non-saving income, you have trading income, employment income, property income, then interest in the interest column, and then dividend. Look at very carefully. Listen. Then you have, once you will calculate the total income, then you will deduct the interest paid. This interest paid is basically, this interest paid is basically qualifying interest paid. This interest paid is basically qualifying interest paid. This is qualifying interest paid. Qualifying interest paid. I'm sure you all guys know about what is qualifying interest. What is qualifying interest? Okay. When you take loan, when an individual takes loan for certain qualifying purposes, then that loan is called qualifying loan, and that interest, that qualifying loan interest is deducted directly from this main income tax computation, right? Okay. So three columns: non-saving, interest, dividend, total income. First of all, we'll calculate total income, then we'll deduct interest paid, then we'll come to the net income. Now at net income, we'll apply the brakes. Now we'll add these three points, this and this, and we'll go here. Okay. Now from this total net income, we'll deduct two things. The first thing is gross gifted donation. And the second thing is gross personal pension contribution, if it is given. Okay. Once you will deduct these two from net income, you will get ANI. Stands for adjusted net income. Now listen very carefully. You better know that your personal allowance is dependent on ANI. Your personal allowance is dependent on ANI, right? Okay, let me show you. Listen carefully. If your ANI, look at the screen. If your ANI is less than 100,000, means from 0 to 100,000. If your ANI is from 0 to 100,000, then you will get a fixed personal allowance of 12,500, right? If your ANI is between 100,000 and 125,000, means if your ANI is greater than 100,000 and less than 125,000, then you will have to do reduction working. Working means your personal allowance will gradually decrease. Right? Okay. And if your ANI is greater than 125,000, then you are not eligible for any personal allowance. That means your personal allowance will be zero. Right? Okay. So three columns: total income, then net income. On net income, you'll apply break. You'll go to the side working. Then you will calculate ANI. Through ANI, you will calculate personal allowance. And once you will calculate personal allowance, you will deduct it from this column. Okay. And then you will finally get the taxable income. Now listen, taxable income is the income on which we directly apply the tax rate. One thing is very important, you all must know this, that for personal allowance and qualifying interest paid, what is the order? The order is always deduct personal allowance first from non-saving, then from interest, and then from dividends, right? Non-saving, interest, and dividend. Okay. Now do one more thing. Once you calculate the taxable income, always calculate the taxpayer's status. Always check the taxpayer status, whether your taxpayer is the basic rate taxpayer, is it higher rate taxpayer, or additional rate taxpayer. Okay. If this taxable income is lower than 37,500, total taxable income is lower than 37,500, then the guy is the basic rate taxpayer. If the taxable income is between 37,500 and 1,50,000, then this guy is higher rate taxpayer. And if it is more than 150,000, then this guy is additional rate taxpayer. Okay. Now these are the tax rates. These will be given to you in the examination as well. Okay. I have broken down the 0 to 37,500 into 0 to 5,000 as well. Normally in majority cases you don't need to break it out like this. In normal situations your bands are 0 to 37,500 the first band, then the 37,500 to 150,000, and then 150,000 and above, 150,000 and above. Okay, just the difference is, look at the screen, this 0 to 5,000 band, it has a special rate for interest that is 0%. It has a special rate, for interest income that is 0%. Otherwise, listen, for non-saving these two are same, for dividend these two are same. Okay, just for the interest income, my dear students, there is a special tax rate of 0%. There is a special tax rate of 0%, special tax rate of 0%. Okay, I'll discuss it, don't worry. Now, individual tax bands are extended because of two reasons. For individuals, tax bands are extended because of two reasons. Number one, if you have a gross GAD, like gross gift aid donations, if gross gift aid donation is given in the question, then you need to stretch the band. Okay, and because of gross personal pension contribution by an individual, then you need to stretch the band. Okay, these are the only two things because of which you stretch the band. And which bands you stretch? This basic rate band and this higher rate band. Okay, this 37,500 and the 150,001. Okay, there is no need to stretch this 0 to 5,000 band. Never ever stretch it. Okay, I repeat, which two bands you are going to stretch for individuals? 0 to 37,500, this 37,500 band you will stretch, and the next one is 150,000 band. You will also stretch. Okay, by this gross gift aid donation and gross PPC, gross gift aid donation and gross PPC, right? Okay, now what is the tax computation order? Whenever you start computing tax, always compute tax on non-saving, then interest, then dividend. First non-saving, then interest, then dividend. Okay, now listen to me very carefully. Whenever I teach to my student, I teach this topic, this tax computation, in two slots. First case, if you're non-saving, look at here, if your non-saving taxable income, if this non-saving taxable income is greater than 5,000, if your non-saving taxable income is greater than 5,000, then make these bands, 0 to 37,500 and 37,500 to 150,000. That's it. This is the simple allocation. I repeat, whenever your non-saving taxable income is greater than 5,000, then make the bands, make the drawing like this, 0 to 37,500 and 37,500 to 150,000. Because in such cases you don't need to use this, this 0% band of interest income. You don't need to use this 0% band of interest income. Okay, in such cases, how you will calculate? First of all, you will compute tax on non-saving. Then you will come to interest income. How to calculate interest income? How to calculate interest income in this case? How to calculate interest income tax on this case? First of all, you'll apply NRB, nil rate band. You guys better know by now that for interest income, nil rate NRB is given according to the taxpayer's status. If the taxpayer is basic rate taxpayer, then he or she will get 1,000 NRB. If the taxpayer is higher rate taxpayer, then he will only get 500 NRB. And if the taxpayer is additional rate taxpayer, then no NRB on interest will be given. Okay, so for interest income, how you will calculate the tax in this case? First of all, calculate NRB according to your status and then compute the normal tax. Okay, now finally, when you will come to dividends, for dividends there is only one rule. For dividend income, NRB is 2,000, fixed NRB irrespective of your income. Fixed NRB irrespective of your income is how much? it's 2000. Okay, and then normal tax. So I repeat, for dividend income, the tax computation order is first NRV, which is 2000, and then normal tax. And NRV means 2000 times 0%. That means, in shortcut, whenever you need to calculate tax on dividends, just do 2000 times 0% and then normal dividend tax. Okay, this is the order. This is the order. Now, the second case. The second case. Sometimes this, look at the screen. Sometimes this non-saving income, non-saving taxable income, sometimes this non-saving taxable income is less than 5,000. This first column, the non-saving column's taxable income is less than 5,000. In that case, now you need to use this 0% band. And now the band allocation will be, look at here, this will be your band allocation. 0 to 5,000, then 5,000 to 37,500, then 37,500 to 150,000, 37,500 to 150,000. This will be your band breakup. This will be your band breakup. Okay, in this, in which case, look at here, when to use, see my question, read the question. When to use this 5,000 0% band of interest? When non-saving taxable income is less than 5,000. Whenever the first non-saving taxable income column is less than 5,000, then you will be using interest income 0% band. Interest income 0% band. Okay, and in that question, the band allocation will be like this. See, the band allocation will be like this, and this will be the order of interest income tax computation. Listen, first of all, number one, the first priority is use this 5,000 band. Use that 5,000 band of 0%, then use NRB of interest, which is always according to your status, and then normal tax. I repeat, in this special case, whenever the non-saving taxable income is less than 5,000, you need to calculate interest income in 3 steps. Now, first of all, use the 0% band, that 5,000 band. Number two, then use interest NRB according to the taxpayer's status. And number third, the normal tax. Normal tax. Okay, right? Now, again, I have written here, we never stretch 5,000 band because of gift aid and gross PPC. Never ever stretch that 5,000 band because of gross PPC and gift aid. We never stretch. Okay. Now, there is a small topic, I'm sure you are aware of it, the transfer of personal allowance between spouses, between husband and wife. Okay, the transfer of personal allowances between husband and wife. Okay, now what are it happens sometimes that husband or wife has unused personal allowances. Husband or wife has unused personal allowances because of less income, right? So yes, you can transfer. How? The first condition is both of them must be basic rate taxpayer. Both husband and wife must be basic rate taxpayer. This is the first condition of this transfer. The second thing, fixed amount is allowed. Only 12,500 is your standard allowance. You can only transfer 10%. So 12,500 times 10% is 1250. So you can transfer to your wife, or wife can transfer to the husband, fixed 1250 personal allowance. Okay. Now the third thing is very important. The person who is receiving the personal allowance will reduce his or her final income tax liability. What does it mean? It means the guy or a girl which is receiving the personal allowance, he or she will not increase his or her personal allowance. He or she will get the relief. How he or she will get the relief? By deducting the net tax benefit of this. See, 20% because they are basic rate taxpayer. So 1250 times 20%, in the end you can deduct 250 from final income tax liability. These are the conditions. Don't forget, They may ask you this thing in MCQ, right? Okay, so 2 marks is also very important. 2 marks is also very important, and this paper is all about memorization, sharp memory, right? All of you, please join the WhatsApp group. Next, there is one area which we call pensions. In your normal classes, you always do pension with income tax computation. You always do pension with income tax computation, right? Okay, let me give you a quick recap. First of all, there are two principal types of pension funds. One is state managed, and second is private pension. Second is private pension funds. Okay, state managed pension fund means that is a mandatory thing, like NIC, like national insurance contribution. Obviously, right now we are not discussing NIC. Right now we are not going to discuss NIC, and that NIC thing is mandatory. There is no option. You have to contribute at any cost. Okay, but the second thing, see the second heading, private pension funds. Private pension funds is an option for all individuals. If you want to participate, yes, you may. If you don't want to, it's okay. So there are two, whatever we are discussing right now is these two, right? Okay. So in the private pension fund, there are two options. One is occupational pension plan, and the second is personal pension plan. Occupational pension and personal pension plan, right? Have a look, please, and be very active during this class. This is totally, everything is going to be revised. Your routine class is going to be revised. Okay. Next. Now, occupational pension plan. Occupational pension plan, this is the plan which is maintained by your employer, and this is totally connected to employment income. This is totally connected to employment income. Now go very simple. Your employer also contributes in this, and employee also contributes in this. Employee if employee is contributing if employee is contributing in this occupational pension plan, then this is an allowed expense. This is going to be an allowed expense from employment income PNL of that employee. Okay, in this way employee will get relief. In this way employee will get relief. Okay, you can read it. But if the employer employer is contributing, then this will be an exempt benefit for employee. The first thing is employee. See, employer is contributing in my pension, so first of all it's going to be an exempt benefit for employee, first thing. And number two, for employer, as employer is investing on employee, as employer is doing expenditure for employee, so for employer it is an allowed expense from trading income PNL of employer. For employer it is an allowed expense of from trading income PNL of employer. Okay, you can have a look. Please check it out. Quick one. Now, personal pension plan. Now this thing, see this personal pension plan. Personal pension plan has nothing to do with employment income. Any individual can go and join a pension fund. Can open its own personal pension account and start contributing it. Okay. Now, first of all, if any individual contribute in his or her personal pension account, then this is not an allowed expense. First of all, it is not an allowed expense from any PNL, first thing. Okay. But yes, you are going to get the relief. How you are going to get the relief? 3 points. See the 3 points. The first point is you just have to contribute 80%. The remaining 20% will be contributed by the government, HMRC. Okay, like for example, You want to contribute 1000, you want to contribute 1000 in your personal pension, so you just have to contribute 800 net. You just have to contribute 800 net. Remaining 200 will be contributed by the tax department. Okay, so I sometimes say it's a physical help. I sometimes say it is a physical help, like there is one hand of yours and the other hand of the government in your pension account. Okay, right? The second thing, your band will be extended. Your bands will be stretched. Bands, because of personal pension contribution, you all know your bands will be stretched. Even I discussed just right now in income tax competition. Number three, your ANI will be reduced. Your ANI, adjusted net income, will be reduced. ANI will be reduced. Okay, so these are the three reliefs when a person himself or herself contribute in his or her personal pension account. Now, what happens when your employer contributes in personal pension contribution of employee? Same thing what we just discussed, same thing. For us it's an exempt benefit, for employee it's an exempt benefit, for employee it's an exempt benefit, but for employer it's an allowed expense. It's an allowed expense from trading income P&L of employer. It's an allowed expense from trading income P&L of employer, right? Now, one more thing. I'm sure you guys are aware of this technical issue. Tax department gives lot of reliefs for pension. Tax department gives lot of relief for pension, but you know there is a limit for all these reliefs. Tax department says we can give you reliefs up to a certain extent. Okay, so look at me and think over it. There is a cap, there is a limit of relief, but there is no limit of contribution. You can contribute millions of pounds, yes you can, but yes, the relief will be limited. Tax department will limit the relief. Tax department can't stop you from doing contributions. You can do any amount of contribution, that's allowed, but yes, there is a cap on the relief. So that this thing is annual allowance. Annual allowance is the maximum pension contribution on which tax department allows pension relief. See, there is a limit on the relief. Okay, after that they don't give relief. Okay, now this include these all reliefs we take. See, these all are the reliefs, these all are the relief. If employee himself or herself invest, contributes in his own occupational pension scheme, definitely he gets relief through allowed expense. If your employer do contribution in occupational pension scheme, yes, we get relief through exempt benefit. The number third, if individual himself contribute in his or her personal pension account, then obviously through band stretch and physical help you get relief. And then whenever your employer do contribution in personal pension plan, again you get relief through exempt benefit. So in these four areas individual gets relief. Individual gets relief. Okay, right? Now there is a limit of annual allowance. Annual allowance is 40,000. Annual allowance for any fiscal year is 40,000. But yes, there is a good news. What's the good news? That if in the previous year you have, in last 3 years, you have any unused annual allowance, you can use it now. In last 3 years, if you have any unused annual allowance, you can use it now. Okay, but how to use it? One technique. Listen. For example, in 2021 you have 40,000 annual allowance, and you have in last 3 years you have also 40 unused. Okay, so how you are going to use it? Always use current year first. And then the earliest year, right? Always use current year first and then earliest year. Okay, this is the order in which you have to utilize your annual allowance. Okay, now one more thing. Annual allowance is available to a taxpayer who is member of registered pension scheme in that year. Yes, membership is must. If you are a member of a registered pension scheme in that year, then you can avail all these annual allowance relief. Now, what if you step out? What if you step out? Look at here. In my class, in my routine class, I used to say a word, return working. If your total reliefs, if your total reliefs from pensions, if your total reliefs from pension exceeds your annual allowance, total annual allowance, then the excess will be treated as a non-saving taxable income. The excess will be treated as a non-saving taxable income, and you need to return tax. Then you need to return tax. Read this line. Read this line, please. Please. Now, few more things are coming. I'm sure, I know these are a lot of things, though a lot of things to learn, but yes, this is your paper. You have to tapering annual allowance. Listen, annual allowance will be reduced if your AI, adjusted income, is greater than 240,000. I repeat, annual allowance will be a normal annual allowance for 2021 is 40,000. Now I'm talking about pure 2021. Now I am talking about pure 2021. Listen to me very carefully. If your 2021 annual allowance is 40,000, normal. But if your AI stands for adjusted income, is less than 240,000, then it's perfect. If your AI, adjusted income, is less than 240,000, then it's perfect. Then you are eligible for 40,000 annual allowance. But if your AI is greater than 240, if your AI is greater than 240,000, then your annual allowance will be reduced gradually. Then your annual allowance will be reduced gradually, and there is a limit. There is what happens to the voice? Can't you listen? Can't you hear me? Hello? Hello? Voice is okay. Yes, it's okay. Maybe in your internet there is some issue. Listen, if your AI is greater than 240,000, then you need to reduce your annual allowance by $1, £1 for every $2, £2 excess. Okay. But yes, there is a limit that you reduce your annual allowance, yes, to the maximum of 4,000, to minimum of 4,000. Okay. Now look at here. So what is AI? What is AI? AI is the combination of these three things. AI is the combination of these three things. I'm sure you know this. Listen. Your net income, your total net income, employee contribution in occupational pension plan, and employer contribution in occupational and personal pension plan. These three things you will add. This is called adjusted income, or you call it AI. So limit, then you'll deduct the limit. If there is any excess, then you will divide the excess by 2. Then you will divide the excess by 2, and you will reduce it from, and then you will reduce it from your annual allowance, Okay. Now see this. Minimum annual allowance after tapering concept is 4,000. Minimum annual allowance after tapering concept is 4,000. That means, yes, you can reduce your annual allowance, reduce, but there is a lower limit, lower lock. There is a lower lock of 4,000. There is a lower lock of 4,000. Okay. Don't forget this. Now, have a look, please. Have a look. Now, I'm going to solve a question with you guys. Yes. First of all, keep one thing in your mind, that you are doing revision. Okay. Obviously, in my normal classes, I have given 6 to 7 hours for this thing, 6 to 7 hours for just pension thing. Okay. Right. Yes, I'll send you this. Slide. Don't worry. Now, first of all, see the question. You need to compute income tax. Salary, only income in this question is salary. Only income in this question is salary. How much is the salary? Salary is the non-saving income. Salary is the non-saving income, and we call it employment income. Wait, but let me write salary, no issue. 130,000. 130,000, right? Now, there is one allowed expense. Employee, double E means employee. Double E stands for employee. Open your eyes. Employees' contribution in occupational pension scheme. Yes, yes, it's an allowed expense. Less employee occupational pension contribution. This is 20,000, right? Now, wait. So this is your final employment income. Final employment income. Now, wait. How much is this? 110. There is no bonus in this question. There is no car benefit. There is no fuel benefit. No such thing. This is your full and final employment income. Okay. Now wait. Next thing is employees contribution in personal pension. Employee is the guy himself, and he is doing personal pension contribution. That means I'm the employee. I'm doing personal pension contribution in my own account. So this is net. See, it is net. Personal pension contributions are paid net. So first thing I'll do is gross up. First thing I'll do is gross up. I'll calculate the gross PPC. First thing I'll calculate the gross PPC. You know, guys, how to calculate gross PPC? Simply divide by 80 times 100. Divide by 80 times 100. So this is 40,000. Look at here. Divided by 80 times 100. 40,000 divided by 80 times 100. What is this? It's 50,000. Okay. So 50,000 is your gross PPC. Just for your knowledge. Okay. Now let's read the third line. Employer contribution in occupational pension scheme. Employer. You know, when employer contributes in your occupational pension, it's an exempt benefit. It's an exempt benefit. And when it is an exempt benefit, you won't write in the employment income. It's exempt. It's exempt. So you no need to write it. And you already got the relief. Okay. Now, next thing is, let's calculate the income tax. Let's calculate the income tax. Look at here. Let's calculate the income tax. How you are going to calculate the income tax? This is your employment income. There is no other income. There is no other income other than its employment income. Okay. So this is your only income. Please look at me very carefully, students, please. This is your only income. So this will be your total income. Okay. And there is no qualifying interest. So this will be your net income. Now you will take this net income. You will take, write this net income right here. Listen, net income. This is your net income right here. How much is 110? And now two things you need to deduct. Number one, less gross PPC. Gross PPC. How much is the gross PPC? It's 50,000. How much is the gross GAD? There is one more thing in the question. See, this is gift aid donations. They are also net. Gift aid donations are net. You know what to do with gift aid donations. Divide by 80 times 100. So how to calculate gross GAD? It's 8,000 divided by 80 times 100. So it's 10,000, right? Okay. So you will have 110 minus 50, 60, the 10, 50. Your ANI is 50,000. Your ANI is how much? 50,000. Okay. Your ANI is 50,000. Okay, students. Now, so now when your ANI is 50,000, so that means your ANI is less than 100,000. So your personal allowance in this question will be 12,500. So I think its taxable income is how much? 97,500. Your taxable income is 97,500. Okay. Now, there is one more working which we all should not forget, and that is adjusted income working, AI working. Okay, because the AI hits your annual allowance. AI hits your annual allowance. Okay, so let's do the AI working. First of all, you will write your net income. First of all, you'll write your net income. In this question, your net income is 110. See, this 110 is the net income because there is no qualifying interest. So 110,000 is your net income. Then add employee contribution in occupational pension. It's 20,000 if you have seen the question. Then employer ER contribution in any pension. Now in any pension, whether it is personal or occupational, any pension of employee. I think in this question it's again 20. It's again 20. So tell me this, if we add these three, it becomes 150,000. So your AI is equal to 150,000. Now you tell me. Now guys, you tell me, whenever your AI, please, you have to give the paper. Whenever your AI is less than 240, it's only 150. Whenever your AI is less than 240, sorry, it means in this question it's 150. So no need to taper, no need to reduce your annual allowance. Okay, so good news is that enjoy with your 40,000 2021 annual allowance. Complete 40,000 annual allowance is available to you, right? Okay, plus you have some brought forward as well. Don't worry. How much is the brought forward? Tell me guys, how much is the brought forward, please? This is the brought forward. Okay, 10,000 is the brought forward as well. So current year you have 40. In the current year 2021, current year fresh, you have 40,000 available, and from previous year brought forward you have 10,000. So this makes around 40 and 10. This makes around 40 and 10, 50. 40 plus 10,000, 50,000. You have 50,000 annual allowance with you. You have 50,000 annual allowance with you. Are you getting, guys? Are you getting? Please reply on the chat box. You have 50,000 annual allowance with you. You have 50,000 annual allowance with you. Okay, now the next step is let's do tax computation. But before we do tax computation, let's do some return working. I'm sure you know the return working. Okay, ANI is very simple. ANI is net income. ANI is basically total net income less gross gifted and gross PPC. See, it's very simple. It's old working. Now, what about the return working? Let me show you the return working. See this. How many reliefs did we get in this question? How many reliefs overall we get in this question? Let me count. First of all, employee contribution in occupational pension. This was the first relief of 20,000 we get. Then we get employer. Our employer also contribute. Employer contribution in occupational pension. This is also 20,000. Okay, then employee, this guy, we contribute in our employee contribution in personal pension. Now wait, this is a dodge. This third line is a dodge. Wait, here you have to write the relief amount. All of you, please look at me. This thing you may forget. Listen, this employee contribution, sometimes we write word, I use a word TRC in my class. TRC, tax relief contribution. TRC, tax relief contribution. Now this for personal pension, this is an area of mistake. Students can do mistake. Even the examiner has written comments on this. Listen, wait, first of all, you need to stretch the band. Your normal bands were, wait, 0 to Normal bands were 0 to 37,500. You know, individual bands are stretched because of two things. Individual bands are stretched because of two things. Number one, gift aid donation. Yes, gross gift aid was 10,000. And number two, look at the screen. Number two, you have to stretch bands because of personal pension. You have to stretch bands because of personal pension, but for that you must know one thing which is called relevant earnings. For that you must know one thing which is called relevant earnings. You know what relevant earnings are? Relevant earnings are sum of three incomes, employment income, trading income, and income from furnished holiday letting. In this question, there is no furnished holiday letting, so forget about it. There is no trading income in this question, so leave it. But yes, there is employment income. So how much employment income you have? How much employment income, students, you have? 110. This is your relevant earning. Okay, this is your relevant earning. Now compare your relevant earning with your gross PPC. Compare your relevant earning with your gross PPC. What is the lower amount? That is 50,000. So you will be stretching your bands with 50,000. Okay, so now write 50,000. This is your TRC. This 50,000 is your TRC. Okay, similarly, the next band, which is 150,000, you will write 10 plus 50. So your updated bands will be, it's 97,500 is the first band, and your second band will be 210,000. Okay, so what are the capacities? Let me write. The capacity of first band is 97,500, and the capacity of second band is 110. How much? 210 minus 97,500 is 11,2,500. The second band is 11,2,500. Is this? Yes. Okay. Please check. Yes, sir. Okay, now hold. So this, we were doing this return working. This is return working. Listen. So we have, how many reliefs did we get in this question? For one is employee contribution and occupational pension scheme. Yes, we get relief on this. Then employer contribution and occupational, again we got relief. And finally, the TRC through band stretch, we got 50,000 relief. Through band stretch from personal pension, we got relief of 50,000. So these were our total relief, less annual allowance. How much annual allowance we have? How much? Wait, why you are asking 60? I know we stretch the band with 60, but 10,000 is GAD, gross gift aid. Gross gift aid is not part of pension. Gross gift aid is not part of pension. Be very careful. This is a very big mistake. Now, you get the relief of 90,000 overall, and now you have to deduct annual allowance. How much annual allowance is available to you guys? How much annual allowance is available to you guys? 40,000 for current year and 10,000 old. 40,000 for current year plus 10,000 old. So how much is the final excess? Tell me, how much is the final excess? I think it's 40,000. This excess will be treated as a non-saving taxable income. This will be treated as a non-saving taxable income. This will be treated as a non-saving taxable income. I know these are much things, but still it's your paper. And you have taken the normal classes as well. Okay, so now the last step is left and everything is done. One last step is left and everything is done. And what's that step? You need to calculate income tax. You need to compute income tax. Okay, so how you're going to? First of all, All incomes are non-saving. There is no interest or dividend in this question. There is no interest or dividend in this question. Everything is non-saving. Okay, so you are going to pick your 97,500 income and you will knock this first band. You will knock this first band. So luckily your first band, the capacity of first band is exactly 97,500. So complete 97,500 taxable income will be taxed at the rate of 20%. Now listen, look at here. Non-saving, look at here. 97,500 at the rate 20%. This is how much? 97,500 times 20% is, I think, how much? 19,500. Thank you. Now, normal tax computation done. Now let's do the excess charge. How much is the excess? Excess is 40,000. Excess is 40,000. Excess is 40,000. And now you know you have to treat this excess. You have to treat this excess as a non-saving taxable income. As a non-saving taxable income. So again, come to the band. This band is already consumed. This band is already, you will bring this 40,000 to the first band and you will knock. You will bring this 40,000 to the first band and you will knock. So this first band is already done, consumed. Okay, so obviously you will come to this band, and yes, there is a lot of capacity here. So for this second band, the tax rate is 40%, which is 16,000. So tell me please, 19,500 plus 16,000 is, this is your final income tax payable. This is your final income tax payable. This is your final. Please have a look. Have a look. Everything inside, in front of your screen. Everything in front of your screen. Sorry, it's 35,500. My mistake. Sorry. I saw wrong. Sorry, it's 35,500. See this. Take your time. Take your time. Did you understand? Please reply. Okay. Now, one more thing. This is a very good topic which normally students ignore. No, in return working, these are the maximum things. One student is asking, yes, these are the maximum things. What are the maximum thing? Let me tell you. The TRC, which is related to my own personal pension contribution. Number two, my employer's contribution, whether it is occupational or personal, and employee's own contribution in occupational pension. These are the three major things. Okay. Now, one thing which is very good, you must know. Listen, you can see the format here. You can see the format has here non-saving, interest, dividend. Okay. Now, in non-saving, you have a property income. In non-saving, you have a property income. If you click to property income, there is a proper P&L. If you double click on the property income, there is a separate P&L. And don't forget this thing. That property income P&L is always made for fiscal year. For individuals, property income P&L is made for fiscal year and it's on cash basis. It's on cash basis, receipts less payments. Okay. Advertisement for tenant, agency commission, and so on. Right. Okay. But don't forget that for individuals, property income P&L is always made for fiscal year. Okay. Always made for fiscal year. Right now. Then you have employment income. Then you have employment income. Listen. If you click on employment income, so you will go to this P&L. Again, employment income is P&L is made for fiscal year. Don't forget, employment income P&L is also made for fiscal year. Salary, bonus, car benefit, fuel benefit, accommodation, this, all these things, all this P&L is done for fiscal year, right? Now, the important thing, trading income. If you click on trading income, you will go to this world. If you click to trading income, you will go to this world, and this world is for accounting period. This whole world, if you remember, this whole calculation is done for accounting period. The trading income P&L is already made for accounting period, not fiscal year. Keep this thing in your mind. Keep this thing, okay? And for trading income, what you have to do, for trading income, you have to do a full-time journey. What is that journey? Right from accounting net profit to tax adjusted trading profit. Normally there are 4 adjustments: add back all those expenses which are allowed in accounting but not allowed in tax. Similarly, you have to deduct capital allowances, you have to deduct other incomes, and so on. This is a complete topic, okay? So this hard work you have to do. This hard work you have to do for trading income. Now hold. And this whole journey is for accounting period, not fiscal year. This whole journey, this whole trading income journey is for accounting period, not fiscal year. Not fiscal year, please. Now, once you are here, now you have, once you have calculated the tax adjusted trading profit, now be careful. Listen, these are the mistakes. Read the first line. If it is the old business, that means the business started few years back, 5 years back, old business. So that means already business has been started already, and the opening year rules of basis period already applied. So now for future years, we apply ongoing rule. For future years, we apply ongoing rule. And you guys know better than me, for ongoing rule, we just do copy paste. So you don't need to do anything extra. If it is an old business, then you don't need to do anything extra. Anything extra here, right? You just have to copy paste. This tax adjusted trading profit in the non-saving income column and just do tax computation. That's it. Right? This is the first line. Now read the second line. If it's a new business, if you have covered the whole journey right from accounting profit to tax adjusted trading profit, and it's a new business, you come to know that it's a new business and this is the first year of accounting period. Listen to me. This is the first year of accounting period, and accounting period and fiscal year is not aligned. Accounting period and fiscal year is not aligned. Then you have to apply opening year rules. Then you have to apply opening year rules of basis period. Okay. Finally, if this is the last year of business, then you need to apply closing year rules. Okay. Now see this, read this. If it is the last year of business, don't forget to deduct overlapping profit from last year basis period. Okay. If it is the last year of business, then obviously you have to deduct overlapping profit from the last basis period, because this is the last chance you have. Are you getting the points? Please reply on the chat box. Hit the chat box, please. Next. Now I'm going to give you a very short, quick revision of basis period, quick revision in my own style, right? From my point of view, basis period opening year rules, there are two heads. For basis period opening year rules, there are two heads. The first head I have written normal cases, and for second I have written special case. What is the special case? First, let me tell you what is the special case. In which when you start the business, let us say you start the business is 7-8 fiscal year, you start the business in 07-08 fiscal year, and your first accounting period is ending in 09-010. See, you started the business in 7-8 and your first accounting period is ending on 09-010. That means there is a jump, there is a skip, there is a jump of one complete fiscal year. See, there is a jump, because after 7-8 there is 8-9, after 7-8 it's 8-9 and then 9-10, after 7-8 student it's 8-9 and then 9-10. So there is a jump, there is a skip of one fiscal year. So this is a special case. And now let me tell you the rules of this special case. In this special case there are only three steps. For this special case there are three steps. Let me tell you. The first step is the universal rule, what I call universal rule. You, from the starting date of the business, you go to the first fiscal year. From the starting date of the business, you go to the nearest 31st March. Okay, this is the first piece. The second step is exactly the middle fiscal year, the midway fiscal year, you copy paste the full fiscal year in between these two. Okay. And the third step is look, listen very carefully. You come back 12 months back from the end of the accounting period date. You go back 12 months from the end of the accounting period. These are the three steps for this special case. And what is the identification of the special case? One fiscal year skip. Like you started the business in 7-8 and your first accounting period is ending in 9-10. This is the identification of a special case. Okay, this is the special case, the big case. And now the normal cases. What happens in normal cases? Normally business starts in one fiscal year and first accounting period ends normally next fiscal year. Okay, so for these normal cases there must be three events. Three events. The first is very easy plus my favorite. Only one step. Only one step in it. Very easy. What is that step? Listen. Let us say you start the business, from the starting date of business. All this, the first step is always common. In opening year rules, the first step is always common. From the starting date of business, you go to 31st March. From the starting date of business, you go to 31st March. And you know, luckily, in this first step, you cover the whole first accounting period. In this first step, if you cover the whole first accounting period, then say thanks to your God that the opening year rules are finished. In just one step, opening year rules are finished. No extra work. Now just apply ongoing rule. Okay, so this is the easiest step. Now for second, let us say from the beginning of the business accounting date, you go to first 31st March. The nearest 31st March. Okay, but still the first accounting period is not covered. The first accounting period is not covered, but still the first accounting period is not covered. Now you have only two options. First thing is first try 12 months back from the ending date. 12 months back from the ending date of the first accounting period. And if this 12 months back is not possible, If this 12 months back is not possible, then go 12 months forward from the opening date of the accounting period. That's it. That's it. That's it. I repeat the second case. From the start of the business starting date to 31st March, okay, you do this first step, and you find that the first accounting period is not yet covered completely. You haven't covered the first accounting period completely. So now you have only two options left. The first, always do first this ending dates, sorry, from the end of the first accounting period 12 months back, from the end of the first accounting period 12 months back. And if this 12 months back is not possible, then from the beginning of the first accounting period 12 months forward. That's it. That's it. And yes, overlapping profit, you need, in all these cases, you have to check about the overlapping profit. In all these cases, you need to check about the overlapping profit. You need to check about overlapping profit. You need to check about overlapping profit. Now, this is closing year rules, is when you close your business. There are only two cases. There are only two cases in closing year rules. Just read it. If you're just see the ending date, always for closing year rules, be active and see the ending date of last and second last accounting period. That's it. For closing year rules, see the ending date of last and second last accounting periods. Now, if this is the first case, if last and second last accounting period ends in different fiscal year, they both have their own fiscal year. If last and second last accounting periods end in different fiscal year, then no need to do anything extra, just ongoing rule, just ongoing rule. That's it. Ongoing rule. That's it. But if last and second last accounting period ends in same fiscal year, they have same fiscal year, they lies in one fiscal year. If last and second last accounting period, if the ending date of last and second last accounting period ends in same fiscal year, now you have to merge them. Now merge them. And see what is written with the red pen. See what is written with the red pen. Okay. Now, there is one topic which we call self-assessment individuals. Self-assessment individuals. I'm sure you guys know that for individuals, there are three payment dates. First POA, second POA, first POA, second POA, and balancing payment. For individuals, there are three payment dates. First POA, second POA, and balancing payments Okay. Normally, first, let me tell you the normal rules. Normally, payment on account is calculated with reference to last year. Payment on account is calculated with reference to last year. For example, if you need to calculate payment on account for 2021, you need to use the data for 1920, right? Okay, 1920. See this 2021 POA is calculated on the basis of 1920 data. And you need to take ITP, the last year income tax payable, and last year class 4 NIC. Last year income tax payable and last year class 4 NIC. Okay, just these are assumed numbers. I've taken my own numbers. So it's 20 plus 10. Total relevant amount is 30,000. And you know there are two payment on account, so you multiply it by 50%. So this is 15,000 is your POA. 15,000 is your POA, right? So for POA calculation, we take income tax payable of last year and class 4 NIC of last year. Income tax payable of last year and class 4 NIC of last year. Okay, right? Then what are the due dates? What are the due dates for this? Let me show you the due dates. These are the due dates. For the for 2021, first payment on account is 31st January 21. That means in between the fiscal year. And after 6 months, there is second payment on account. And after 6 months, there is the balancing payment, the balancing payment date. See the screen, and I'm sure you know this. Then in balancing payment, we consider everything. In balancing payment, we consider all actual taxes. In balancing payment, we consider all actual taxes, including CGT and Class 2 NIC as well. In balancing payment, we consider everything, including CGT and Class 4 NIC, Class 2 NIC as well. See, so for balancing payment 2021, see this actual ITP 2021, actual CGT you have taken, actual Class 4 NIC you have taken, actual Class 2 NIC, these all things. And now some tax you have already paid through POA. Some tax you have already paid through POA. This will be deducted. So you will get a balancing payment. You will get a balancing payment. You will get a balancing payment. This balancing payment will be done for 2021. For 2021, this balancing payment will be done on 31st of January, 31st of January 2022. 31st January 2022. This balancing payment will be done on 31st January 2022, right? Okay, right. Balancing payment of 2021 will be done on 31st January 2022. Please look at very carefully. Now, on this 31st January 2022, you have to pay, you have to submit one more thing, which is called electronic tax return. This is the last date of electronic tax return as well. This is the last date of electronic tax return as well. Now, read these lines, these are important. POA is computed on the basis of last year ITP. POA is calculated on the basis of last year ITP and Class 4 NIC, okay? CGT and Class 2 NIC are always paid in actual through balancing payment. Don't forget, CGT and Class 2 NIC are always paid in actual, because CGT is a non-recurring thing. Never include CGT and Class 2 NIC in the computation of POA. In the computation of POA, we never ever include CGT and Class 2 NIC. Okay. Now, one thing. If you pay your electricity bill late, definitely you have to pay interest. You have to pay something extra. This is the rule of the world. So if you pay your POA or any payment, POA or balancing payment or any payment, if you pay your any payment late, you have to pay interest, and this late payment interest is 2.75% per annum. This late payment interest is 2.75% per annum, 2.75% per annum, right? Okay. Now, for POA and balancing payment, both you have to pay. If you pay them late, you have to pay interest. But for balancing payment, if you pay it late, there is a penalty as well. There is a penalty as well, and you guys know this. There is a penalty as well. There is a penalty as well. Okay. Now, one more thing. If an individual wants tax department to compute his or her tax, then he or she can submit documents before 31st October 2021. Listen, this is your 2021 fiscal year, and you want tax department to compute your tax, then you have to submit the document before 31st October. Before 31st October, then they will do the tax computation for you. Okay. And now one more thing. There are two types of tax return. One is paper-based tax return. And the second one is electronic tax return. One is paper-based tax return, and the second one is electronic tax return. If you want to do hard copy, physical copy tax return, submit hard copy tax return, then look at here. Then the last date is 31st October 2021. But if you want to do electronic tax return, which is a fashion, then the date is 31st January 2022. But remember, open your ears. If if you cross this 31st January 2022, if you didn't submit your tax return on time, if you didn't file your tax return on time, then the penalty will start after 31st January. Okay, the penalty, that there are penalties on return as well. There are penalties on return, and it comes in the last exam. It comes in the last exam. I'm going to discuss this MCQ, the real MCQ of exam, with you soon. See, these are the penalty for late filing of tax return. These are the penalties for late filing of tax return. Listen, your last date of tax filing of return for 2021 is 31st January 2022. Student, please invest your time, invest your efforts. Your last date for return filing for 2021 fiscal year is 31st January 2022. Okay, now if you didn't submit on time, then the first penalty is 0 to 3 months. If you are only less than 3 months late, then there's a fixed penalty of 100. But if you cross 3 months, means 3 to 6 months, now you will have to face an additional daily penalty, that is 10 pounds per day. 10 pounds per day. So, you know, from 3 to 6 months, it's 90 days. 3 to 6 months, there are 3 months, that means 90 days. 3 months means 90 days. Okay, so 10 pounds per day multiplied by 90 days, it's 900 pounds. It's 900 pounds. It's 900 pounds. It's 900 pounds. Okay, students, this is additional penalty. Then if you crosses 6 months, you are not paying 6 months, then you will have one more penalty. Then you will have to pay one more penalty, and that is higher of 5% of tax liability and 300 pounds. Two things we will compare: 5% of tax liability and 300 pounds. Now, this is after 31st January 2022. My innocent student, your due date, wait, let me write. Okay, sorry. Yes. I'm sorry. I didn't update the date here. Sorry. No issue. It's third, but I was saying 31st January 2022. 31st January 2022. So once you cross 31st January 2022, then you have to face these consequences. Okay. And believe me, this thing came in the MCQ, real MCQ. And these all are additional penalties. These all are additional penalties. Taking now we are going to do real exam MCQs of very latest attempt. So don't go, don't leave. Okay, so just take a 2 minutes break, 2 minutes break, and then we'll start. Okay. Okay. We are going to discuss the examiner latest examiner report of March June 2021. March June, this is the latest available on the net, right? This is the this document is given by ACCA, disclosed document. Everywhere it's available. Okay, now see, first of all, they have given you some questions from the, obviously they don't disclose all MCQs, but some MCQs they disclose, or some one OTKs they disclose, right? Okay, so this is the first MCQ. Giving you guys 3 minutes. 3 minutes you have. Come on, start. I just taught you this tax return thing. Start. Okay, now listen, students. First of all, they are talking about the electronic tax return of 2021. You must know the dates. It's all about memorization. This paper, you need good memory. For 2021 fiscal year, the last due date for electronic tax return is 31st January. See, this is January 2022. Okay, this is the last date. Now, but you submitted your return in August 2022, 10th of August. You submitted return on 10th of August 2022. So you are 6.5 months. You are 6.5 months late from the due date. Okay. Now, what penalties for they are only asking you the penalty for return. See, they are not asking you the penalty for tax. They are asking you the penalty for tax return. This is the biggest issue. You guys don't read the requirement. Pause yourself and read the requirement properly. Requirement is everything. So I just taught you, if you file your return late, then what will be the consequences? Listen, for first 3 months, let me change the color. For Feb, March, for these 3 months, there is a fixed penalty of £100. Okay. For these 3 months, there is a fixed penalty of £100. For next 3 months, it's £10 per day. £10 per day multiplied by 90 days. £10 per day multiplied by 90 days. So it's going to be 900 additional. So 100 plus 900, 1000. 100 plus 1000, 900, 1000 is done. Now you cross the 6 months because you paid on 10th August. You submitted on 10th August. That means you are more than 6 months late. So now you will have one more penalty. This is higher off. First, you will write £300. And second, you will write 5% of your income tax. What is your income tax? Look at the income tax, 8,400. 5% of 8,400. How much is 5% of 8,400 is, I think, 420. Okay. So one more 420 penalty you have to pay. One more 420 penalty you have to pay. So three penalties you have to pay. This is £100, £100, then £900, then £420. 100, 900, and 420. So if you sum these up, it's going to be C. It's going to be C. 100, 900, and 420. Did you get it? Next one. Okay, the super easy question, super easy scoring question. Come on, do it. Scoring question. This is about closing year rules, giving you hint. Okay. This is about closing year rules. Read the requirement. Which fiscal year they are asking? 2021. And yes, in the 2021, you have closed the business. You close the business here. This is 2021 fiscal year. My dear, yes, you close the business on 2021 fiscal year. Now, you studied two rules. For closing your rules, there are only two cases. The first case is if last and second last accounting period ends in different fiscal year. For that, we do ongoing rule. And sometimes last and second last accounting period ends in same fiscal year. Wait, this is your last accounting period. See, this lies in 2021. The ending date of last accounting period ends in 2021, lies in, and this is second last account. See this date, 30th June 20 also lies in 2021. The date of 30th June 20 is after 6 April 2020, my dear students. So see, this is the case number 2. The last and second last accounting period ends in same fiscal year. So you have to merge them. You have to merge these two. You have to merge these two. You have to merge these two. So 11,200, add it, 11,200 plus 7,300 is I think 18,500. Okay. And now as this is the last basis period, so you need to deduct overlapping profit. You need to deduct overlapping profit. So deduct 2,600. So 18,500 less 2,600 is how much? 15,900. This is your answer. 15,900 is your answer. 15,900 is your answer. To be very honest, this is exam question, and this question was not difficult. Yes, the previous one was a little bit non-routine, but this is something easy. Okay. Okay, do this one. This one is also super easy question for you guys. Do it, please. You remember the 85,000 limit for historic test? Historic test. 85,000 limit for historic test. You know that? Now listen. You have 1 or 2 minutes as well. 1 minute more. Let me start. See, you have Jan, Feb, March, April, May, June. This is third. Then July, August, September. Then you have October, November, December. Listen, for Jan, Feb, March, you started on 1st January 20. Okay. For Jan, Feb, March, it's 15,000. Okay. Okay, 15,000, right? Then April, May, June. These 3 months, 15,000 is less than 85. It's less than 85. So still go forward. Now, for April, May, June, it's 20,000. Again, 15 plus 20 is how much? 15 plus 20 is how much? It's 35. Still we haven't crossed. Then July, August, September, it's 30. So 15 and 20, 35 plus 30, 35 plus 30 is 65. 65 still. Now, in these 3 months, the answer is 33. So 33,000 divided by 3 per month is 11,000. Look at here. So now you already done 15, 20 and 30. That is 65 is you already till September you already touched 65. Now for October it's 11. 65 plus 11 is how much? 65 plus 11 is how much? Is 76. Okay. And now still you haven't crossed 85. Now if you add 11 for November, so this will be 87. Yes. Now let me tell you my dialogues. At the end of November, 2020, wait, 2020, at the end of November 2020, trader realized that last 11 months, last 11 months sales taxable supplies exceed 85,000. So now he has 1 month, to apply, 1 month to apply. Okay, so now at the end of November he realized this. Now he has complete December month to apply. He can apply by the end of December, and tax department will make him register from 1st of January 2021. From 1st of January 2021, he will be the registered guy. He will be treated as a registered guy. So this is the answer. 1st January 2021 is the answer. From what date will Francis be registered for VAT? 1st January 2021. You are not getting. I just proved that by the end of November, by the end of November, this guy realized, this trader realized that he crossed 85,000. So once you cross 85,000, so you have 1 month time. So from the end of the November, you have 1 month time. That means till 31st December you can apply. And yes, tax department will consider you registered from the very next day, that is 1st January 2021 in this question. This was the beginning of VAT, beginning question of VAT, beginner question of VAT. Yes, he can charge to VAT from customer from 1st January 2021. Obviously, he is registered then. Okay, the answer is B. I'll send you, I have already sent you this examiner report before, but do read it. They will discuss the wrong answer as well. See, they have discussed the wrong answers, that what students think. These are the alternative wrong answers. See what mistakes students can do. So please invest your time in these things. Now, this is your, wait. You have now example number 4, which is IHT, inheritance tax. IHT, again, easy. Only you need to calculate tax on chargeable state, that is death state. This is your death state, and you need to calculate tax on death state. You need to calculate tax on death state. Come on, quick, start. No need to calculate everything, just this death state tax. First of all, date of death is very important. Which is 15 January 2021. Plot this date and go 7 years back. 15 January 2021 is important. Plot this date and then go 7 years back. Okay, let me do it. See, your date of death is 15th of January 2021. Just go 7 years back. Just go 7 years back. So the date will be 15th January 2014. Okay. So these are last 7 years. These are last 7 years. Okay. The value of estate is, I think, the debt chargeable estate is 245. Okay, 000. Now, wait. Where are your gross chargeable CLT? The one CLT is in October 13. See, you have one CLT in October 13. This CLT 98,000. It's in October 13. More than 7 years old. More than 7 years old. So it's irrelevant right now. It won't come in the reduction. Then you have one more CLT. You have one more CLT in June 2017. Yes. 118000. This is the full picture. Wait. Let me write it correctly. This is the full picture, students. This 15 January 2021 is your date of, it's the date of death of this person. I went seven years back. I went 7 years back. Okay. This is 15 January 2014. So these are last 7 years. These are last 7 years. Okay. Now read the requirement carefully. Read the requirement carefully. What they are asking? They are asking calculate the inheritance tax for chargeable estate. Only death state. We have to calculate death state. And for death state, we are standing here. For death state tax calculation, we are standing at the date of death. We are standing at the date of death. And we'll look at 7 years back from the date of death, because death state working we are doing. Okay. So now listen, your estate, let me do little work for you. Your estate is 245,000. Your estate is 245,000 less NRB. Normal NRB is 325. And can you see anything in last 7 years? Did you calculate tax? Yes, this thing is in last 7 years. Not this. This CLT is not in last 7 years. So only 118,000. So 118,000 must have consumed your NRB. So 325 less 118 is, I think, 207. 325 less 118 is, I think, 207. 245 less 207 is 38,000. Okay. So the excess is 38,000. And for death taxes, there is only one tax rate, which is 40%. So 38,000 times 40%. 38,000 times 40% is how much? 15,200. 15,200 is your answer. This is your answer. This is your answer. You can check it out. You can check, please. Oh, for death state, no annual exemption is available. For death state, no annual exemption is available. For death state, no annual exemption is available. And one more dodge. For CLT, they have already given you gross. See this word. For CLT, they have given you gross chargeable lifetime transfer. For CLT, they have given you gross chargeable lifetime transfer. That means gross chargeable lifetime transfer means annual exemption already deducted. Annual exemption already deducted. Go and study the chapter again. Go and study the chapter again if you don't have this concept. Gross CLT means gross chargeable transfer means everything is done and annual exemption has already been deducted. This is the meaning of gross chargeable transfer. Okay, so nothing to do with annual exemption. And for death state, no annual exemption is available. So answer for this question is 15,200. Answer for this question is 15,200. Now we are going to discuss the OT case, one complete OT case for CGT. One complete OT case for CGT, okay? One complete OT case for CGT. For that, I'm giving you 2-3 minutes. Yes, paper leaf only on PAT and additional IST on CLT. Very good, very good, very good, very good. Thank you, thank you, thank you. Please eat properly and sleep properly. This is your question. This is your question, please. Just go through it. Just go through it. Just read it. Just read it. Okay, let's start. Lily disposed of various assets. Please, this is the last question of today's class. Just give some energy for now. Lily disposed of various assets during the tax year 20, resulting in the chargeable gains. Now, first of all, this is your first. A copyright sold. See the copyright. There were special rules for copyrights. Remember copyrights. For copyrights, it's you studied a topic wasting assets. And this is not wasting chattels, normal wasting assets like copyrights, like trademarks. Remember intangible assets. For this thing, just keep one thing in mind, that in normal working, what you do, DP less cost. What you do, how you calculate gain, DP less original cost. But for this copyright topic, you do DP less NBV, DP less net book value, disposal proceed less net book value. Remember, so you need to do some depreciation thing as well. Okay, so now, so you sold the copyright on 30th June 2020. The copyright had been purchased on 1st July 17. See this date, 1st July 17 for 22,000, when it had an unexpired life of 15 years. Okay, so from 1st July 17 to 30th June 20, how many years have been passed? From 1st July 17 to 30th June 20, tell me. 3 years. You sold it after 3 years. You sold it after 3 years. Okay, so now let me solve it complete. DP is how much? No, DP is not given and not necessary. Even in the question, he won't ask you the DP. Now, what should be the NBV now? What should be the NBV now? NBV is, look at here, NBV is cost less accumulated depreciation. Cost less accumulated depreciation. Cost is 22,000. And what is the accumulated depreciation for 3 years? Accumulated depreciation for 3 years is 22,000 divided by 15 multiplied by 3. 22,000 divided by 15 multiplied by 3 is the accumulated depreciation for 3 years. Can anybody calculate 22,000 divided by 15 multiplied by 3? 4,400. Thank you. So your NBV will be 17,600. This is your NBV. And yes, even in my class, I also teach this shortcut method. You can directly calculate NBV through 22,000 times 12 upon 15. 22,000 times 12 upon 15, you can directly calculate this NBV. You can directly calculate this NBV. So now, student, when we will compute the gain of this copyright, when we are going to compute the gain of this copyright, how much cost will be deducted? 17,600. NBV is deducted. NBV is deducted in the computation of gain. For copyright, in the capital gain calculation, we deduct NBV. Okay, so 2 marks done. Let me show you the question. First, read this. Please have a look. What cost figure will have been used in calculating the chargeable gain? Don't sleep. In calculating the chargeable gain on the disposal of Lily's copyright, answer is 17,600. Answer is 17,600. Okay. Okay. Now, next. You remember we did this part disposal thing. In part disposal is a very common feature of all CGT classes. Part disposal. See, so this is the part disposal story. 4 hectares of land sold. You sold 4 hectares of land. Okay. Lily had originally purchased 6 hectares, total 6, on 30th May 2008 for 84,000. This is original cost. This is your original cost. 84,000 is your original cost. Don't forget of complete 6 hectares. The 4 hectares of land were sold for 140. Yes, one portion is sold. And the market value of the unsold means remainder is 60,000. Prior to the disposal, Lily spent 14,400 on clearing and leveling the 4 hectares of land. The portion sold, this cost, listen, this 14,400 is incurred pure on the portion sold. I'm sure I taught you this in the class. Only few costs are apportioned. All costs are not apportioned. Yes, this original cost we need to apportion. This original cost we need to apportion. This we need to apportion. Okay. So kindly get me the allowable cost. Kindly get me the allowable cost of this transaction. Or if you can calculate the gain, you can calculate gain also. You can calculate gain also or allowable cost for this whole event, that 4 hectares event. Giving you 2 minutes. 2 minutes you have. Okay, let me start. Wait. So listen, students. This is your complete. You sold 4 hectares. DP is 140. Market value of remainder. Wait. We sold this 4 hectares and DP is 140. Market value of remainder is 60. Original cost for this complete plot is, I think, 84,000. Original cost of this complete plot is how much? How much? 84,000. Yes. So my dear student, this 84,000 will be apportioned between these two. This 84,000 will be apportioned between these two. Okay, right? Okay. Then, but there is one cost which we call it leveling cost. Leveling cost 14,400, which is incurred only on this portion. This leveling cost incurred only on this portion which is sold. So it is this portion is completely sold, so this cost will be completely given to this portion. This cost will be completely given to this portion which is sold. No need to apportion this 14,400. No need to apportion this 14,400. Okay, now let me solve it properly. So what you will do, you will write dp of the portion sold is 140 less allowable cost. Wait, the first leveling cost we'll take complete leveling. This will be complete 14,400 we'll take, and then original cost we need to apportion 84,000 times weight dp upon dp plus market value of the remainder. So how much is this? How much is this? 84,000 times this. Can anybody tell me 84,000 times this? 58,800. Thank you. Now tell me what is the final gain? What is the final gain? $66,800 is the gain. 66 gain. I'm asking about the gain. Gain. Okay. An examiner may ask this question: what is the total allowable cost? Can anybody tell me what is the total allowable cost? This. See, this is the total allowable cost. These two. These two is your total allowable cost. These two is your total allowable cost. Okay. So 58,800 plus 14,400. 58,800 plus 14, it's 73,200. 73,200 is your total allowable cost. Is your total allowable cost. Let me check. See, what are the total deductions which will have been allowed in calculating the chargeable gain? The answer is 73,200. The answer is 73,200. 73,200. The answer is 73,200. Okay. Now let's move to PPR. PPR. Now wait. This is your PPR thing. I'm just giving you to the point discussion. Yes, if entire leveling is given, then you need to apportion the leveling cost. Listen, students, this is your PPR area. And when you were studying PPR from me, leave that thing, what we used to say, that in PPR we discussed one more relief. What was the name of that relief? I forgot the name. Sorry. In PPR, we studied one more relief with PPR, letting relief. Yes. Forget about letting relief in this question. Forget about letting relief in this question. Leave it. Forget it. Only it's a normal PPR question. It's a normal PPR question. Remember 3 columns: total months, exempt months, and chargeable months. Look at me. Total months, exempt months, chargeable months. Total months, exempt months, and chargeable months. Okay. Read this story and just tell me the exempt months. Just tell me the exempt months. This is the requirement. Very simple. I'm telling you. Read this paragraph from here to here, and just tell me exempt months. That's your target. Exempt months. It's easy requirement. Exempt months. Okay, still 1 minute you have, still 1 minute. Come on, try your luck, try your luck. Okay, let me explain you. Listen, first of all, giving you a quick summary. If you are staying in your house, it's exempt. Occupied time is exempt. And if you are going leaving your house, but there is a sandwich, occupation, then absence, then again occupation. There is a sandwich. And if it is and the absence, the reason of absence is A, B, or C, A, B, or C, then still it's exempt. And last 9 months are always exempt. Last 9 months are always exempt. Okay. Now listen. First of all, in the beginning, you are staying in your house. These 32 months are exempt, for sure exempt. Okay. Plus there is a sandwich layer. You stayed in your house. There is a sandwich layer. Now, traveling overseas means without any reason, it's point A and it's exempt. 36 months you can go anywhere. 36 months you can go anywhere. Okay. And then required to work elsewhere in UK. This is point number C. But remember, for point C, only 48 months. You can claim relief till 48 months. So out of this 60, 48 is exempt and 12 is chargeable. 12 is chargeable. Okay. Now listen. Then again you came back, so it's a sandwich. Again you came back, it's a sandwich. And if you occupy your house, it's full-time exempt. Now then you leave house and you didn't see, all last 20 months are unoccupied. Last 20 months are unoccupied. That means you didn't come back, so there is no sandwich. There is no sandwich. But yes, last 9 months are always exempt. Last 9 months are always exempt. Last 9 months are always exempt. So can anybody tell me the exempt months? Can anybody add all these months? How much? 145. Yes, 145 is your answer. These are your relief or exempt months. Now, let's see this. What is the total period, both actual and deemed, for the purpose of calculating private period of C? What is the total period of occupation? That means sometimes when you stay in your home, it's occupied and it's exempt. And when you leave your home and if it is deemed A, B, C, or last 9 months, then it's also exempt. So they are asking, see that it's a special style. It's a special style of asking total exempt months. So answer is 145 months. Answer is 145 months. Okay. Now, guys, please, just 2 MCQs are left. Please give me some energy. Student, remember you studied paper to paper takeover, P2P, paper to paper takeover. And in paper to paper takeover, sometimes you give your existing shares, you get new shares. Shares versus shares. Shares versus shares. But what happens sometimes, you give your shares, you give your existing shares, and you get some cash and some shares. You give away your existing shares and you get some cash and some shares. Remember? So in that case, you do part disposal working. In that case, you do part disposal working. You do part disposal working. Okay, let me show you. This is the game. See. This is. Lily had originally purchased her pound one ordinary shares in Moon PLC. Moon PLC. Originally, we invested in Moon PLC. Please look at very carefully. Think over it. In the exam, you will find these things, and this is real exam question. Student, this came in just think June 21, very near. So you will find such question in exam. So you have to think very deeply. Lily had originally purchased her pound one ordinary shares for 27780. Wait, let me make a box. See, originally I had full box of shares. And what was the cost? The cost of this box was 27280. 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 Now I gave away my box. See, under the terms of the takeover, Lily received cash 19800. Listen, this is my DP. I received cash 19800 and I received 22,000 shares. These are my shares. 22,000 shares I received. And what is the market value? Market value were Sun PLC. Pound one is the face value. You have to use market value. Were quoted means the market price. The market value is 2.2. C. So 22,000 multiplied by 2.2 is how much? 22,000 multiplied by 2.2. What is the market value? 48,400. 48,400. This is the market value of the remainder. This is the market value of the remainder. Okay. So now just think, you just received cash. Student, look at here. This portion is your cash. And yes, this should be treated as part disposal. Even I teach this thing in my class. I taught you guys, those who studied from me, I taught this in class. Remember, this is the case of P2P takeover with cash involvement. P2P takeover with cash involvement, and it is treated as part disposal. Okay. Now just simply do part disposal gain. Wait, what is your DP? 19800. Okay. Less. What is the original? This cost you need to apportion between these two. 27280. Multiply by, first write the DP 19800, divide by DP plus market value of the remainder, which is 48,400. Can you tell me what is the 7920? 7920 is the cost, allowable cost. And what is the gain? I want gain. 11,880 is the gain related to the cash. This is the gain related to the cash, which is your answer. Okay, students, this part was easy. Let's go to the question. Wait. Now, the last question, just read the requirement. They are asking you the capital gain tax liability. What is Lily's sister's capital gain tax liability? This is very, very basic tax computation question. Very basic tax computation question. Okay. Lily's sister's capital gain tax liability. Let me take you to the question. See, this is the question. This is the Lily's sister. See, from here, all of you try it. All of you try it yourself. This from here till here, just calculate the CGT. That just calculate the CGT. You all can do it. To be very honest, if you can't do this question, then you guys should resign. One who can't do this question, then he or she should resign. This is very basic question. See, Lily's sister has chargeable gains of 44,200, which is qualify for business asset BADR, old entrepreneur relief, and now business asset disposal relief. It's QG qualifying gain, and 107,400 chargeable gains relating to a disposal of residential property, which is not her main residence. That means RPG. You know what is RPG? Gain of residential property. No matter if you are not living in it, still it's RPG. Okay. Now, first of all, Lily's sister does not have any other taxable income. Okay. Only two gains, no taxable income. Now you tell me there is one thing which we call annual exemption. From which gain we have to deduct annual exemption first? Always RPG. Annual exemption we'll deduct. So how much is this now? 95, 100. Okay. Now let's start tax computation. In this question, there is no non-saving interest, there is no interest, no dividend. So first of all, we'll calculate on QG. Flat tax rate is 10%. This is 4420. This is first gain. Okay. And as your QG is 44,200, that means your complete 37,500 band is consumed. So now your RPG will come on the second band. And you know the second band rate of RPG is 28%. So 95, 100 plus 28% into 28%, how much? 26628. This is for RPG plus 4420. This is QG. How much is the total liability? How much is the total one? 31048. Did all of you complete this question yourself? At least you should. Otherwise, simple one answer, resignation. Okay, so this report is not finished yet, but you know the remaining part of this report, that means the very latest past paper, I have recorded recently, very latest past paper means March, June 2021 past paper of section C past paper. So I'll send you on the WhatsApp group, okay, right? And it's in my YouTube channel as well, okay? So work hard and stay tuned on the WhatsApp group as well, and don't waste your last days, please, right? Concentrate and think positive, inshallah you will clear. Okay, so that's it for today's class. Take care, bye bye, Allah Hafiz.